Hello everyone, welcome back to Crack Grade B and very good morning to all of you. So today we are going to do material costing. Material and labor costing is we have completed all the advanced level of costing like we have talked about marginal costing, job costing, contract costing, right? But somewhere or the in another way, whatever I'm going to discuss today, we have already discussed in our previous classes. But this was required to be summarized under one topic or under one lecture. Hence, I am conducting this particular lecture on material costing so that all the basics, whatever are required with relation to the material, are covered under one head and you don't have to think about it twice while reading it. So let's continue with our material costing. So what I am going to talk about in this particular lecture is, see, in costing, your ultimate or what is your ultimate objective is. So we are doing costing, right? In costing, my ultimate objective is to find out cost per unit. Whatever my product is, whatever product I am selling, I want to find out that what is my cost per unit. Why I want to find out my cost per unit? Because I have so many objectives. Determine profitability, right? Next is control on costs. I want to perform cost reduction as well as cost control. Hence, I want to find out what is my cost per unit. Next is I want to make various management decisions. Management decisions like whether I should continue this product or I should introduce a new one or I should increase the quantity of production for this particular product. All of these are various type of decisions that I need to take and I will take with the help of costing. Now, cost per unit, what are the elements of cost? So my elements of cost are material, labor, overheads. In overheads, I have various types of overheads like I have factory overheads, I have administrative overhead, I have selling and distribution overheads. Correct? So these are all my items of expenses on those I spend. So today I am going to talk about material. Your Institute of Cost Management Accountants of India, they have came out with the cost accounting standards. Just like you have accounting standards for your financial accounting, in a similar fashion, you also have cost accounting standards as well. So we are going to study CAS 6 as well for material. Means there is nothing very special written in CAS 6, right? So let me clear this point very first to you that nothing special is written over here. Whatever you have read in bits and pieces till the current time, that this is the same thing which you are going to study in this particular lecture as well. Nothing is that much special that okay, something else will be given to you. Nothing of that sort will happen. You will be understanding it in a very easy way. Correct? So we are going to talk about all these heads of expenses one by one, that what are the rules of costing regarding these particular products, regarding these particular expenses, what cost should we include, what cost should we exclude, all of these things which we are going to discuss. So let's start the lecture. See, material costing is the process of determining what we want to determine, that the cost at which inventory items are recorded into stock as well as their subsequent valuation in the accounting records. So material related costing, obviously that is going to impact your inventory valuation as well. Why that it will impact our inventory valuation? Because just now I have told you the purpose of costing is to find out what is the cost per unit of production, at what is the cost at which you have produced the inventory. That means ultimately you want to find out that what is the material cost that has been incurred, what is the labor cost that has been incurred, and what are the overheads that has been incurred in order to produce one unit of inventory. You want to find out the valuation for the same. So this is the purpose of material costing. We want to find out that what is the cost of material that has been incurred in production of the inventory. Understood? Now let's move on. There are two stages in case of inventory. Number one is for initial inventory acquisition. Suppose you are into a biscuits manufacturing entity, right? Your work is to manufacture biscuits. Now what are the raw material that is required for biscuit manufacturing? Maida, sugar, correct? Refined oil, and some cashews and other things that you want to add, correct? Skimmed milk powder, all of these are what your ingredients, correct? So let's take the most important ingredient, that is maida. And obviously I am not the producer of maida, I have to purchase maida from the supplier. So this is my input material that I am going to purchase. Now, how I will perform the valuation of this input material? This is called as material cost for initial inventory acquisition. Your inventory is of three types. You should be understanding this particular thing. When I am saying the word inventory, see, whenever I say the word inventory, it means three things: raw material, work in progress. Work in progress is nothing extraordinary. This is the main between stage of production, and the last one is finished goods. So when I am talking about the initial recognition or the initial valuation, at that time I want to talk about raw material, because this is my initial stage and this is my at the end of stage, that is my finished goods, right? So let's see what we have to do over here. So a company must decide whether it will record acquired material at their purchase price, or if additional cost will be added such as freight and sales taxes and custom duty. The addition of these other costs is allowable, but many require a certain amount of additional work. It is easier to charge these additional costs to expense as incurred, so they appear immediately in the cost of goods sold. Overhead is not allocated to raw materials since these items have not undergone any production activity. See, this is so very important. Now let's talk about it. We have already talked about the material related accounting standard as well, inventory valuation. There we have studied that all the expenses those are being incurred in order to bring the material in the present location and condition is included in the cost of material. That's what they are also saying you. Suppose I have purchased maida. So what are the costs that I have incurred in order to purchase maida? Number one is I must have paid the purchase price to the supplier. This is the price that I have paid to the supplier. Now next thing which comes in my mind is transport. It may so happen that transport was arranged by supplier, can happen that way as well, and it may also happen that he was not having any transport facility. I had to arrange transport. So I will add transportation. Correct. Next, loading unloading. That expense also I have incurred. So that is my cost and I will include into the material. So loading unloading. Next thing, all the non-returnable duties means the such duties for which you are not going to receive the credit, that should become part of your material cost only. Correct. So non-refundable duties. Although now GST is being applicable, but we receive the credit of GST as well. But sometimes it happens, suppose you have purchased the maida from a composition dealer who has opted for composition scheme. So any particular tax that he'll be applying on the invoice, you will not receive any credit for that from the government. So if that is the case, what you have to remember is you don't have to remember the taxations, you just have to remember all non-refundable duties and taxes. These will be added in the price of material. So that is how you will find out that what is the total inventory valuation for you. I am repeating this statement again. This is the statement which is followed in accounting standards as well. We have studied AS2 and this is what being followed under CAS 6 as well, right? So there is no much of a difference in between these. It says that please value your inventory at the cost which has been incurred in order to bring the inventory at present location and status. So what happens is whatever cost you have incurred in order to bring maida till your factory location, all those costs will be added in order to find out the cost of inventory. Now the next very important thing over here is, in case of raw material, overheads are not allocated. Why not allocated? Because the cost of inventory says that you should include all those costs which you have incurred in order to bring the inventory at its present status and location. But you have not performed any activity on the raw material. That is the work of your supplier. You just have transported it and brought it to your location. That's it. That much work you have done. So if you have not done any work on that raw material, you are going to perform raw work on the finished goods. So you will be adding overheads in finished goods. You will not add overheads in the cost of raw material. Is that clear? Now next, see what they are saying. So overhead is not allocated to raw materials. Why? Because these items have not undergone any production activity with which overhead is associated. I have told you three types of overheads: factory, administrative, selling and distribution. These will be incurred when the production will happen, and if you have not done any production, obviously you have not performed any production related activity on raw material, then you will not add production cost. Now material costing for subsequent valuation. This is for your finished goods, right? So what will happen over here? Once the inventory has been received into stock, it is subject to the lower of cost or market rule. This we have already studied in our accounting standards. Remember this particular thing. So in a sense, this rule says that recorded cost of inventory should be at lower of its recorded cost or market return. From a practical perspective, this rule is usually applicable only on those inventory items having the largest extended cost. Its application to low value items would not result in any material changes. So the other thing which you should remember about your FG valuation is it will include material cost incurred, labor incurred, overheads incurred, right? All the total of this will be called as cost. Once you find out the cost, then see whether cost is lower or market value is lower. Why this rule is applicable? So see over here. Suppose there is a particular item of finished goods that is having a cost of 10,000 rupees, right? This is the cost. Now when I went to the market and I analyzed that what is the market price of the same product, they told me that the market price of this is just 7,000. This is the market price, right? This is the market price. So in this particular scenario, see, if I will be writing this particular inventory item at 10,000 in my books, what ill effects it is going to have, I'll tell you. So first thing first, if I record this inventory item in my books at cost, that is 10,000, whatever I have incurred, see, the problems which I am going to face is inflated profits. Why? Because in my books, stocks are represented in the credit side of P&L. So if your credit side of P&L will be higher, that means if you will show higher value of stock, that will inflate your profit. Next thing is incorrect representation of assets, right? Your asset side of the balance sheet will also be depicted at a higher valuation, and we do not want it. And apart from it, prudence concept of the accounting says that you should anticipate all the possible losses and you should be providing for that. So after following all of these, your accounting standard as well as the costing standard says that you should be recognizing it at the lower of cost or market price. That means I will record the inventory into my books at 7,000. Now let's talk about the cost layering. What is cost layering? Cost layering means at what price you will charge the material to your cost of goods sold. Cost of goods sold means I want to find out that okay, if in the current month I have done the sales of 12,000 rupees, then what is the cost that I have incurred in order to produce these particular valuation of goods, right? So what is the cost that I have incurred in order to sell the 12,000 worth rupees goods? So cost layering tells you that how you should determine the cost. So first of all is the specific identification method. When this particular thing happens is, this happens in the piece of art. Right. Other examples could be jewelry, designer dresses, in totality, what I want to say over here is, if the inventory which you have produced is separately identifiable. Why? Because the material that you have applied to it, the labor which you have applied to it is distinct from the other units that you are producing. These are made to order, right? These are made to order units, and hence specific identification method is applied. So this particular method says that if your inventory or your production, each unit differs from the other unit, then what you should do is, for each of the product you should find out the cost of goods sold separately. This is called as specific identification method. See, assign cost to specific units of inventory and charge these costs to expense when the specific units are sold. These only apply to the expensive and the unique inventory items, right? Like I have told you, jewelry pieces. Each jewelry piece differs from the other jewelry piece in terms of craftsmanship, right? The purity of gold. So every item is separate, and hence we should do valuation of each of the items separately. Next is first in, first out method. So all these are in order to find out your cost of production or cost of goods sold. So suppose I have 20 pieces of inventory in my item. Let's say, let's go back to the biscuit example. So I produce biscuits, and hence for that matter I have maida in my stock. Now 20 packets of maida are there in my stock. 10 packets have been purchased at the price of 60 rupees, and other 5 packets have been purchased at the price of 65 rupees, and lastly 5 have been purchased at the price of 68 rupees. So pricing of all these are different. Now how will I determine that which packet I have used first? So there is a method that calls first in, first out. This method says that whatever inventory you have received at first, please use that first. I'll say okay, fine. So for current production, I had to use 10 packets of maida, and all those packets which have came at 60 rupees, they have arrived very first. And the remaining 5 packets and 5 packets, they have arrived at a later date. So I will choose those maida packets which have arrived at my premises first. That means whatever inventory item that has came up to you first, utilize that first. This practice is applicable in case of finished goods as well. So all those finished goods cartons that you have purchased or you have produced at a earlier date, please send them for sale, otherwise they will expire, right? So this is the first in first out method. Let's see what happens in it. Assign cost based on the assumption that the earliest goods acquired are the first ones sold. If prices are increasing, this tends to result in higher profits. So obviously at the earlier stages when prices were lower, if you are using that particular commodity into your production, then your costs will be lower and profits will be higher. So are you clear with this particular concept, or I should explain it with an example? See, if on 1st January 10 packets of maida have been purchased at 60 rupees, 5th January 5 packets have been purchased at 65, and 10th January 5 packets have been purchased at 68. So first in first out says that which particular inventory has come up to you first. I'll say this one. This came on 1st Jan. So they will say first utilize this for your production. Right? Clear? Now similarly, last in first out. So this particular method says that whatever has came at a later date, please utilize it first. But let me tell you, this particular method is not acceptable in the international financial reporting, and hence therefore not being acceptable in India as well. So this is just a theoretical concept which I have told you. There is no usage of at all of this particular concept. See over here. What does last in first out method says? That assign cost based on the assumption that last goods acquired are the first ones which will be sold or which will be consumed. If we are talking about finished goods, therefore they are saying first sold. Means this practice is applicable on your finished goods as well as raw material. Raw materials are applied for the production process, and once goods are produced, these are sold. So whatever methods I am talking, these will be applied in both the cases, right? It depends on you what kind of method you follow. There is no hard and fast rule that you have to just use FIFO method. No, you can use as per your business model whatever particular thing which suits you most, which suits your cost of production most. You are free to use that, right? So last in first out method, if prices are increasing, then this will result in lower profits. This method is not allowed under international financial reporting standards. That is, this is not allowed under IFRS as well as Ind AS. Correct? So this is not being in practice. This is just a theoretical concept which has been included in order to make you understand. Now next thing, see. Weighted average method. Weighted average means it uses an average of the cost of all the units when charging cost to the cost of goods sold. Now weighted average method means you are finding the average, but you are also giving the weights to it. Weights means see over here, suppose on 1st January I purchased 10 bags of maida at the rate of 60 rupees. Fine. 5th January I purchased 5 units at the rate of 65 units. Right? Now I have two options. One is simple average. I want to find out that what is the price I should be charging to my production. So obviously you also have first in first out method. You can say that suppose I used 7 bags. I used 7 units in production. So someone asked me that what is the valuation for these 7 units. So if I am following first in first out method, then I will say, okay, as per first in first out method, I should be using maida bags out of the units that I have received first. So valuation of these will be 60 rupees. This is as per FIFO method, that is first in first out method. Correct? Now the another method which I have is simple average. Simple average method says what? Suppose I have used 7 bags of maida in my production process. Now I want to find out at what price I should recognize it. So simple average says there are the two prices 60 and 65. Please add both of these. So what I'll do is 60 plus 65 divided by 2. That means 62.5. What I did, I just found out an average of this. This is simple average of the prices. Now I will do the valuation at this particular price. Now the third method which I have is your weighted average. Weighted average says that please give weights to the quantities as well. So what I'll do in weighted average? Again, I have used 7 bags of maida in my production process. I want to find out the valuation of it. So how I will find out? Weighted average says 10 multiplied by 60. This is how I will find out. 10 units multiplied by 60 plus 5 units multiplied by 65 divided by 15. That is total number of units. So what I did in weighted averages, I have given weights to the prices. This 60 rupees, I have purchased more units. This 65, I have purchased less units. So I have given weights to it. Let's see what answer comes. 10 multiplied by 60 and 5 multiplied by 65, correct, divided by your 15. 61.67. So this is how I will do the valuation of my raw material consumption into my cost of production process. All these particular things tell me that how I can do the valuation. Is these examples clear to you or not? Are these examples clear to you? Now let's move to another methods which we have. Now the other methods which I am going to tell you are not that much into use, but I have included it. So just you know the intent behind this, correct? So this particular things have been included for that. This is just for your knowledge upgradation, not being used much because only 4 methods are there. Your FIFO, specific identification, weighted average and LIFO, out of which LIFO is not acceptable in the financial accounting. So that is not accepted. Now we are going to talk about few other methods which are important for you theoretically. Just remember the names that okay, this particular thing also happens. So if you see any kind of such questions in MCQs, you are able to solve it. Number 1 is base stock method. Now remember these particular things, this is not an independent method. This particular method depends on LIFO or FIFO. And obviously you should be striking off your LIFO because that is not applicable. Now base stock means you keep a reserve in the stock. So this happens is we can also call it as a safety level. What happens is, suppose you on a daily basis you produce biscuits, you need maida for it, right? But sometimes what happens is you might not get maida on order, so you should keep a certain reserve for that. Like suppose I know that on daily basis I need 100 bags of maida. This is my daily requirement, correct? So I have decided that okay fine, 100 units is my daily requirement. Why not keep 20 units in the reserve? So that in the times of emergency I can use these 20 units in the production, and by that time my new supply will come in. So you understand the reserve creation. Now, what should be the valuation of is this base stock? That is what we are going to talk about. So, base stock method is, this is the minimum quantity of stock under this method is always held at the fixed price as reserve to meet a state of emergency. This minimum stock is known as the base stock and it is valued at a price at which first lot of material is received and it remains unaffected by the subsequent price fluctuation. The quantity in excess of base stock may be valued either on LIFO basis or FIFO basis. But the base stock, you have to measure quantity, you know. I know the quantity that I always keep 20 bags of maida in the reserve. Now what should be the price of those 20 bags? It should be fixed price at which you have received your first lot of material. That should be fixed. Now whatever you have in excess of base stock, you can measure it on the LIFO basis or FIFO basis, whatever seems reasonable to you. Next is simple average price method. I have already calculated the simple average price method, right? You just calculate simple average of prices, whatever you have received. Next is moving simple average price method. So what you do in moving simple average price method is you include the prices of the coming months. Let's see over here. So under this method, the rate for material issue is determined by dividing total of the periodic simple average prices of given number of periods divided by the number of period. Let's take an example. You'll understand this. Suppose a 3-month period is decided upon, means you want to calculate the prices whatever you have received in the 3 months period. Means I want to calculate simple average of all the prices which I have at which I have purchased my material from the supplier in the past 3 months, right? So how I will do? Suppose you want to calculate simple moving average rate for the month of April. So in this situation, you will make a list of prices from January to March. You will add all those prices and divide the total by 3. That means, see over here, what you will do? You will find out average price. What is the simple average price in the month of January? You will find out average price. Average price means you will have to apply simple average in all these months. February, you have to find out the average price in the month of March, and then you will add all of these and divide it by 3 because you are calculating simple moving average for 3-month period, right? So this is how your moving simple average works. Now if this particular thing shifts to the May, if I want to find out for the May, then what months will I be using? I'll be using February, March, April. I'll not use the average of January. So this is what your moving simple average tells you. Next is replacement method. So replacement price is defined as the price at which it is possible to purchase an identical item to that which is being replaced or revalued. Means in this particular method, I will value my inventory at whatever is the replacement cost. Suppose I have this pen, right? Now what will be the cost of replacement for this particular pen? I will use that particular cost to my books, right? So this is replacement method. Next is your standard price method. We have already talked about standard price. So under this particular thing, you are not taking the actual price, you are finding out the standard price. Finding out standards is a difficult thing, right? because you have to see so many variables. You have to fix standard price, and after that you will find out that okay, this is the standard price of my goods, and at this particular price I should be charging it. So see over here, standard price method. Under this method, materials are priced at some predetermined rate of standard price irrespective of the actual purchase cost of material. Standard cost is usually fixed after taking into consideration the current price, anticipated market trends. This facilitates the control of material costs and as well as judges the efficiency of the production process. So yes, it does, but the main factor under this is finding out the standard cost. Now you can find out standard cost if the price of your material does not fluctuates much. But if the pricing of material fluctuates, it differs, and it differs quite frequently, in that particular situation, using of a standard cost method will not be feasible for your material costing, right? So this is what they were saying, but it is very difficult to fix the standard price when the prices fluctuates frequently. Next is inflated price method. Inflated price method means suppose you have suffered losses, right? So suppose you have purchased 20 units of maida at the cost of 10,000, right? But some quantity of maida has been lost in the transportation. So 5 bags of maida got destroyed while transporting them, and they were not be eligible or being having a good quality to use for the production process. So what you will do is you purchased 20 bags at what cost? Let's say 20,000, right? But 5 bags of maida got destroyed during the process. Now currently what is per bag cost? So per bag is costing me 1,000 rupees. This is per bag. But my 5 bags have got destroyed. So how I will inflate the price? This 20,000 cost I will be charging to 15 bags, right? So this will automatically inflate the price. 20,000 divided by 15, this will give me, now the cost will be 1,333 per bag. Why? Because I have added the cost of destroyed bags to the good bags. Why? Because I have to consume the cost. I cannot leave the cost as it is. I have to consume it somewhere, and hence inflated price method says that in case material that suffers loss in weight due to natural or climatic factors like evaporation and all those things, the issue price of material should be inflated to cover up for the losses. So these are all the methods. I would like to tell you that in your financial accounting, we only follow 3 methods, that is specific identification, weighted average, or the FIFO method. All these other methods are so that you must be knowing what are the terms and how we are using these particular terms. This is very important, right? So for your knowledge upgradation, for your knowledge understanding, I have included all of these. What you are remembered to follow is, please remember the definitions. What do these particular terms do, right? And just having a basic idea of the material costing. We are going to finish your material costing tomorrow, right? Till that time, you will be having all the ideas about the different terms which are used in the material costing. I have already discussed these in separate areas, but not collectively. Hence, I have made a separate lecture for that. Thank you so much for watching this lecture.